Hi, everybody. Thanks for joining me. Before we get started, please be sure to hit subscribe to keep up with all of my latest investing and personal finance content. And please check out the link you see on the screen for a special message from our sponsor, The Motley Fool, where you can get the 10 best stocks to buy right now. All right, so today we're going to look at three high yield dividend stocks. They're not only safe, but they're very much on sale right now. So, first up is a company called Physicians Realty Trust. All three of these are in the real estate sector. There's some great high yield investments available in that sector right now. Ticker symbol is DOC. This is the best performer of the three, down just 30% from its highs. And the reason it's declining is nothing to do with the underlying business. It's mainly due to the rising rate environment. Just kind of a short version: when interest rates rise, investors expect higher yields from their riskier investments like dividend stocks. And since stock price and yield have an inverse relationship, yield rises a bit and price drops. Very good thing for long-term investors. It can be scary if you already own some of these stocks. But right now, Physicians Realty Trust yields 6.7%, very high dividend yield historically for this stock. It's a medical office REIT. It owns 98% of its portfolio are medical office buildings, and most of those, 90% of them, are either on major health campuses or are affiliated with major health systems. So high quality tenants. 95% of the properties are leased. Most of them are on a net lease basis, meaning the tenants are responsible for taxes, maintenance, and insurance, as well as rent. So it creates a very predictable income stream. Medical properties are perhaps the most resilient type of commercial real estate there is. No matter what the economy is doing, people need to go to the doctor, need procedures, need healthcare, and these businesses move very infrequently. So very little vacancy risk as well. Um, a few negatives to mention. So it's not just the stock's down for no reason. The rising rate environment also makes it a little bit more difficult for them to grow. Most real estate companies, including this one, rely on borrowed money to buy new properties. With interest rates going up, it can become a lot less practical to do so. For example, the average property that Physicians Realty Trust bought in the second quarter had an initial yield of about 5.8%. If you can buy properties yielding 5.8% when interest rates were 2% that you could borrow at, that's a pretty healthy spread right there. When interest rates are 4% or 5%, you can see how that becomes a lot less attractive. So the company expected to spend about $250 million on acquisitions and just general growth this year. I don't think it's going to get there. I think it's going to be a very tough environment for this company to grow for the foreseeable future. And that's why it's down temporarily. So very safe business, but it could be a trying time for the company growth wise, which is what investors, I think, are punishing. Number two is a company called Easterly Government Properties, ticker symbol DEA. As the name implies, this is a company that owns properties that are leased to the government. They have only one tenant, the United States government and its various agencies. Um, the company owns 94 properties, primarily office buildings, some outpatient hospital facilities leased to the VA. It's about 35% down from its highs. Again, mainly due to rising interest rates, not anything really wrong with the business except the growth limitations I mentioned earlier. It's the highest yielding of these three. It yields almost 7% at the current market price and virtually no tenant risk. And not only does it have virtually no tenant risk, but all of its leases have inflation protection provisions in it. So if the consumer price index rises, these leases will not necessarily rise exactly accordingly, but there are inflation protections built into the leases to prevent the company from really losing out to rising prices. This is a very high barrier to entry market. There are only a few big players in this space. Easterly Government Property is the number two landlord to the US government, and the US government is clearly shifting from a model of owning its properties to leasing them. It's a more desirable structure, especially in today's environment of budget constraints. So, a lot of room to grow. The next year or so could be kind of challenging, but beyond the near term, I see this company as having a lot of room to grow. Last but certainly not least is a company called STAG Industrial, ticker symbol STAG. This is the worst performer on the list, down about 44% from its 52-week high. It suffers from that combination of rising rates and headwinds in its sector, which it is an industrial REIT. It owns warehouses, distribution centers, properties like that. Amazon is its number one tenant. It also leases a lot of properties to FedEx, other logistics companies like that. It yields 5.4% at the current price. It pays monthly dividends, which is kind of rare. Um, it owns 559 properties in the United States. There are a lot of long-term tailwinds in the industrial space. E-commerce is a big one. E-commerce needs a lot of fulfillment space. Only about 14% of U.S. retail sales right now, but that has been steadily rising and should continue to do so. The biggest drawbacks are one, the cost of capital. Industrial properties have very low yields because they're very valuable right now because of those positive tailwinds. The company is getting cap rates or initial yields of about 5.5% from its new acquisitions, and its borrowing costs are going to rise. Its revolving credit line is at a floating rate, so it's going to make it a little more difficult to grow. And in the industrial sector specifically, there are a lot of oversupply fears. Industrial properties were very, very hot during the beginning of the pandemic as a lot of sales shifted to e-commerce. They built, 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 and we're starting to see signs that they might have overbuilt industrial properties. So that's a near-term supply fear, but that explains why the stock has performed so poorly to this point. But I think it creates a very attractive entry point. So those are my three top picks of high-yielding stocks to buy on sale right now. Hopefully you found them informative, and leave me any questions you might have in the comments. Thank you.
Once again, thank you so much for joining me. Be sure to click subscribe if you don't subscribe to my channel already. And as always, this video is sponsored by The Motley Fool. Be sure to visit www.fool.com/Frankel to receive the top 10 best stocks to buy now.